So have you ever had a month where sales were flying in, you were busier than ever, everything feels great, and then you looked at your bank account and thought, where's it all gone? Well, you're in the right place. So hi, I'm Carmel, owner of Profit Flow, your cash flow strategic partner and the missing piece between revenue and real profit, and the host of Profit Over Turnover. So today we're getting into something that I genuinely think every business owner needs to understand, and I mean really understand, and that is margins. So gross margin and net margin specifically. So the two numbers that will tell you more about the true health of your business than almost anything else. And yet, in my experience, a lot of business owners either don't know theirs or they don't know the figures and they're not sure what to do with them and they don't know how to get them and all of that. So today we're going to fix that. We're going to cover what each one means, why they matter so much, and crucially, how you can do them in your own business. So let's get into it. So, firstly, let's look at what a margin actually is. It's one of those words that gets used a lot without any explanation. So, in simplest terms, a margin is a percentage that tells you how much of your revenue you're actually getting to keep after paying certain costs. Now, the reason that it's a percentage, so it makes it easier to compare year on year. So, how did you perform this year compared to last year? How are you performing against your competitors? And it's regardless of size. So, your competitor could be 10 times bigger than you are, but because it's a percentage, they're comparable because it's what percentage of their sales are they keeping in the different profit centers. So we will go through that now. So if you can think about it, if I were to tell you that I made 50,000 in my business last year, how do you know that's good, or how do I know that's good or bad? So it depends on a lot of things. So if I told you I made 40%, my net profit margin was 40%. It's starting to build up a picture. If you know what that 40% is, you can start to understand what that 40% is. And ultimately, with my net margin being 40%, it is saying that for every €1 that came into my business, I kept 40 cents. So the higher that number goes, the better for me. The lower it goes, the worse for me. So we're going to just go through a few examples and look at this. So let's talk about gross margin first. So gross margin or gross profit margin is the percentage of your revenue that you keep after paying the direct cost of producing or delivering whatever it is yourself. So you may remember that we spoke that direct costs, another name for direct costs could be variable costs. It can be cost of sales. It can be cost of goods sold. So do remember that they all mean the same thing. And it's the costs that directly go into making the thing that you sell. So if you're making furniture, it's the wood, the nails, the varnish, the labor that directly goes into making that furniture. If you're a retailer, it's the price you paid for your stock. So for consultants and service businesses, you may have specific customer costs like tools that you need to subscribe to or platforms or staff hours that go directly into delivering your service to a customer. So for me, I used to do bookkeeping. And I used to hire bookkeepers and, to work with my clients. So their cost was a direct cost for me. I would take that off before I worked out my gross profit. So direct costs do not include the office rents or any your overheads, your marketing spends. These are operating expenses, and I will talk about them now in a moment. So splitting out the cost to direct costs and the operational expenses is so important because you want to be reading the right information. So I'm going to give you an example now. So the formula for gross margin is gross profit over revenue multiplied by 100. And I am going to now just give you this quick example because I know eyes glaze over when we start talking numbers. Mine do as well. So it's just a natural thing. So I want to talk about sales. So if sales in your business was 500,000, it could be 5,000, it could be 50,000, 500,000. And then your direct costs. So this could have been the cost of getting your products into the business, or it could be the actual raw materials that you use to deliver. That was 300,000. And then you have your gross profit is 200,000. So our formula here, our gross margin is gross profit over sales multiply by 100. So in this example, we have the 200,000 over the 500,000 and then multiplied. So you multiply them by 100 and it's at 40%. So you then look at for every €1 that's coming in, you're keeping 40 cents. So again, how good or how bad that is depends on your business, depends on how you did last year, depends on what your competitors are doing. And if it's the first time that you are working it out, that's fine. You have something to work on for next year. So let's talk now about net margin. So net margin is when you take off all of your costs. So your rent, your insurance, all of those indirect costs, those overheads, those expenses, those fixed costs, whatever you want to call them. It's all of your costs in together. And you work that out. The formula is quite similar. And as I mentioned before, for some service businesses, they may not have a gross margin, but all businesses will have a net margin. So again, I want to just share this very professional screen here with you. So we started off with our sales here at 500,000. Then we had our direct costs of 300,000. Then we looked at our gross profit here was 200,000. And we're saying that our indirect costs are 150,000, leaving us with a net profit of 50,000. So again, our net margin is a similar formula we use, but to the gross margin, except we swap out the gross margin for the net margin, and we still have our sales multiplied by 100. Which is not 100%, it's just multiplied by the same figure. So we won't worry about that there now. So now we go down here and we have our 50,000 over our 500,000 multiplied by 100, and that gives us 10, and that is a percent, which is 10%. So again, is that good? Is that bad? It does depend on your business. Often, by way of an example, consultants' businesses where a lot of their costs are in overheads, they will be looking at a net margin around between 30 and 40%. A supermarket where they're bringing in a lot of product and they obviously are paying out their suppliers a lot, they may a net margin of 1 or 2%, but it's based on volume. So they're based on getting a lot of money in at that at 1 or 2%. So the lower the margin that would be typical in your business, the higher the volume that you would need to bring that in. So that is something to understand in your business as well. How is are the expenses split over these different costs, and how are you charging it? And sometimes it can highlight. Remember, we're working out all of our different things. Our gross gross margin is working out what this how this formula is going, and then our net is taking in all of the accounts. So if, for example, your net margin, in our example here, it was 40% and 10%. If next year that went to 50% and 20%, that's great, because the higher it goes up, the better it is for you. The lower it goes down, the worse it is. Now, if you're doing a bespoke business and you have all the rights, you have the IP, and it's a highly profitable, high cost item, you would expect your margins to be higher on the basis that the higher the cost, possibly, in theory, the less volume you have. So your margins should be higher. And this is something that when you're bringing in maybe goods from and you're reselling them, the margins are smaller. So this is something to work out in your own business. These are the information that these provide you about your business is huge. So you have to understand. So they highlight things like your pricing. So is your pricing right? You will see it in your margins if you give a customer a reduction in your sales price, or your wholesalers, they're squeezing you, and it's, whether or not it's worthwhile working with these wholesalers. So that is really a key information for your business. Then it highlights any problems that you have. So I mentioned if your margins go up compared to last year, and they tend only to, if everything kind of stays the same, they kind of tend to only change in 1 or 2% over time. And you need to keep an eye on that. That's signaling to you that you need to be watching those costs. And if you do it over every month, sometimes we do them over a year, and that can hide certain information. But if you should always be doing monthly accounts at a minimum, and you should be looking at those margins and comparing them to the last month as well, just to see what's happening, and then and you really start to understand how your business is working. If you were going for investment or valuation, that margins are key to how investors will look at. They will compare your margin to other opportunities and just want to see how well you're doing. And if you go for a loan as well, they're looking for stability and growth, and your margins can give them that information. And then spotting the trends over time, as I say, is a huge, huge area that you really need to keep an eye on. And it allows you to fix the issue before it becomes a problem, which is what the numbers are really, really good at doing. So how will you check your own margin? So if you're using an accounting software, so a lot of the Xero, QuickBooks, Sage, all of those, if you run your profit and loss account, they will highlight what the margins are. They may not give it to you in the percentages, but if you download our worksheet with this episode, you will get the formulas in there. And so that is something that you can do on a monthly basis. If you're using a spreadsheet, you just use the formula. Make sure all your revenue is gathered together, all your direct costs are together, and then you can work out your gross profit, and then you just apply the formula. And again, you put in your operating expenses, and then you have an operating profit. And you then can apply interest and tax, and then you can work out your net profit. You could also use your operating profit if you liked, because tax to a certain interest and tax is outside of your control. But you could do both. So most accounting software will calculate the gross profit, but they are net profit for you automatically, and then you can just work out the difference. So the key takeaways today would be to make sure that your categorizations are correct, and that you are happy with that, you understand all your costs and that they're going into the right place. Do look at the monthly, not just annually. Annually is a good indicator of how the whole year went, but you want to see those peaks and troughs throughout the year, because then it's easier to identify if a supplier upped their prices, or the pricing was wrong, or you ended up spending a lot of money on marketing that wasn't intended, and all of those different things. And it's just about highlighting things for your business. Also get the benchmark for your industry. What are your competitors? This information isn't widely available, but you can get it if you dig around a little bit for the information. It can be published. If you are with an association for your business, they tend to have this type of figures for their members and things like that. So just look around for them, because it can be helpful. So both of the numbers matter. Use them together, and they give you a much better picture about what is going on within your business. So if you haven't looked at your P&L in a while, let this be the nudge to pull it up this week. Look at the gross profit, your net profit, and do the quick calculations, and just see where you stand. So 10 minutes and those numbers could genuinely change how you are running your business. So I would love to hear thoughts in the comments, and thank you so, so much for listening. And if you haven't already pressed, please press that subscribe button, and I will see you in the next episode of Profit Over Turnover.